Hi, this is Stuart Weems, and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. The first question today is from Darren. Darren writes, I continue to love your podcast, and advice and discussion is really wonderful and appreciated. So thanks so much, Darren. Darren goes on to write, I have a question regarding capital gains tax calculation required when selling an ETF. I've been surprised to discover that I have made, and I'm wondering if I have misinterpreted, or perhaps I'm the only person to know this, although I suspect not. My accountant wasn't aware of this, hence keen to help other listeners in case they are aware too. That's a very long sentence. My understanding has always been that upon purchasing an ETF, in terms of our tax returns going forward, we simply provide the yearly ETF summary to our accountant, which is generally pre-filled via the ATO. And if we sell units, we can calculate the additional capital gains tax based on the selling price and the purchase price as usual. However, I've just read a tax guide provided by BetaShares and was surprised to find that upon sale, we should be modifying the cost base annually by the amount on the ETF tax statement under attributable managed investment trust. AMIT is the acronym, AMIT, in the cost base section. In my situation, by not doing this cost base adjustment yearly, I have been paying more tax than I otherwise would. I do understand that this adjustment can be negative as well. Am I interpreting this guidance correctly? What's going on with the ETF to require a potential cost base adjustment annually? And what is AMIT in layman terms language? Okay, so that is actually correct. It's surprising that your accountant didn't know anything about it. Surprising and concerning, really. So we deal with that internally in our business. Our software deals with that. So they get all the data feeds and then make sure it makes the cost-based adjustment. So essentially, you can think about it like a trust. And like a family trust sort of has a look-through environment. So, for example, I can put $100 into a family trust, and let's say I invest that $100, it makes $20 worth of returns. Income, capital gains, doesn't really matter. And then it sells, a portion of those investments and then pays me, well, let's say it sells all those investments and then pays me $40. So there's still $80 left in the trust. That $40 the trust has paid me is part as capital and then part as income, because the trust has only made $20 in terms of investment returns. So the $20 is taxable. The other $20 is really a return of capital, if you like. And some ETFs are run through sort of a trust structure, some aren't. And so they retain some nature, some trust structure nature. So in situations where you have to adjust the cost base is where there's been a return of capital, and so you've got to reduce your cost base, for example, or the investment has earned more income and capital gains than it's distributed. And so really what they're doing is retaining that profits, and the cost base increases naturally because that's not, when you go and sell it, there's some capital that you've already paid tax on. So that's what's going on there, and that adjustment needs to be made. Yes, annually is the right way to go. And, I think if you've got a significant ETF portfolio, my advice is just use an accountant that has all the software that is able to do it. These days, because of data feeds, you're not going to deal with this manually. If you've got a small share portfolio, well, you can obviously deal with that individually. But great question, Darren, because it is a bit of a technical side, and maybe a good reason why using an accountant makes a bit of sense. Actually, I should say using an accountant that knows these principles more correctly, because, Darren did say he's using one, but his accountant wasn't aware. Okay, next question is from Judy. Judy says, I've got a question, many actually, but I'll keep it to one. Hopefully you can include it in the podcast. My 3 kids have been given $1 million from their grandparents to help them with future housing. However, my kids are varied ages, 21, 17 and 10, which makes it challenging, and we're based in Sydney, which makes it 10 times the challenge. My partner and I are thinking of helping them invest into property with a time frame of about 5 to 10 years so we can then sell it and give them the money for a future home. We were willing to help them stretch it a little bit by taking a loan up to $2 million. We're both 50 and with dual incomes. Because of the varied ages, it makes it hard for us to plan for each of them. The eldest may look to get into property in about 5 years' time. Do you have a recommendation on what we could buy? My partner was thinking of 2 apartments with a good location that can be easier to liquidate and can fetch a higher rent than houses. I'm thinking a house and stretch it to 15 years and let it grow. The kids could either save up and hopefully have a partner to help them with the initial property or even rent. I hope to hear your thoughts on the podcast. Well, it's a really good question, Judy. I mean, I wouldn't do it with a 5 to 10 year time frame. That is, I wouldn't go and buy a property with a 5 to 10 year time frame. In fact, property is always a 10 plus year time frame. Now, it's quite possible to go and buy a property and sell it within 5 years and walk away with a whole bunch of cash, like as in earn a good return. But that can be sometimes just down to luck more than anything else. I mean, if you buy just when a growth cycle is going to hit and enjoy 5 years of a growth cycle, you will do really well. But, you've got to get that timing perfectly well. And as I said, that'll be luck more than anything else. So I think we're going to take a 10 plus year time frame towards any investment or asset purchase. Apartments do much better in Sydney than anywhere else, probably because of height restrictions, and also, there's just a greater focus on increasing density because it's landlocked. Sydney is landlocked by national parks and water. So apartments aren't a terrible idea. Although if I had a budget of $3 million, so the 2 million borrowed plus another million of capital, and a 15-year time horizon, I think I'd buy a house, not an apartment, or I'd buy an apartment that is really special. So say a Bondi apartment that has water views, for instance, and 2.5, 3 million will certainly get you there. A really great apartment. Something like that's going to have a lot of scarcity. Everyone's going to pay for a view all the time. And so that would make a great investment asset. But let's return back to the beginning of the question, where you're making an investment decision for someone that's, for kids that age between 21 and 10, which is a huge gap. And the other thing too is, what we don't know is that the 10-year-old might want to go and buy property, when they're 18, which is only 8 years away, but the 21-year-old might actually want to buy property until they're 40. You just don't know these things, right? Could be circumstantial. They could be traveling the world. They could be doing other things, that they might not be interested in it. All these sorts of things are really hard to predict. So that makes it really difficult. I guess financially, going and borrowing $2 million and then investing 3 million, or maybe 1.5, borrowing 1.5 and investing 2.5 in an apartment in Bondi and holding that apartment for 15 years, I can't help but think that would be an incredibly great financial decision for all 3 kids. The only concern here is the time frame, 15 years. 15 years puts the oldest at 36. Maybe they want the money or use that equity in a different way before that time. So if you could stick to the 15-year time frame, I think that's probably the way to grow the most amount of wealth over that time. But I think you've got to keep flexibility in this arrangement. They've all got, $330,000 that they can use as a deposit. Maybe the best thing to do is just invest it in a Vanguard diversified ETF or something along those lines in 3 separate accounts. Of course, the 17 and 10-year-old will have to be in minor trust accounts until they're 18. And then at least they can at least earn a return on that, and then make some decisions according to, how their life changes or whatever. So I guess it's more of a parental or personal decision rather than financial, but that's what I'd be thinking about. I wouldn't spread it across 2 apartments. I think you could buy a pretty good house for 3 in Sydney from an investment perspective, but I would actually spend 2.5 on an apartment in Bondi with views. Apartments in Bondi have done really, really well over the last 20 or 30 years because of scarcity and planning restrictions. I just don't see that changing. Okay, next question is from Pat. Pat writes, thanks so much for your podcast series, Life Changing. I'm glad you're enjoying it, Pat. Pat gives me a bit of a rundown of his financial situation. Let me summarize it for you. Pat and his wife have 4 children. 4 children. Wow. They live in regional New South Wales. He works in mining, moved across from Perth about 6 years ago, and they would like to move to Brisbane into sort of a metro area just mainly for schooling. Kids are between 3 and 14 years old, and also for tertiary education as well. Pat's got a really healthy income, 400,000. Pat's wife just is almost finishing nursing and in the future will earn about 100,000. They've got 6 investment properties. So the previous home back in Perth plus 5 investment properties. So 1 in Perth, 2 in Brisbane, and 2 in regional Queensland. Total value 4.1 with about 3 mil of loans, so about a 73% LVR. And they've got about 400,000 in cash. They want to buy in Brookwater in Brisbane, which is a sort of new build outlying suburb in Brisbane, on the outskirts of Brisbane at the moment, and build their forever home. They want to build a forever home because they've got so many children. They need a lot of bedrooms, and they feel like if they've got a large accommodation, the kids will hang around a little bit longer, or at least have the capacity to do so. They need to spend about 2.7 to build something at that level. So land 1.2 plus a build of 1.5. And they've worked out that because of serviceability, they can only go to a second tier lender and pay a 2% premium on the loan, and that didn't feel very palatable. They're selling the Perth home because of the 6-year capital gains tax rule. So they'll do that. They'll need about 150 grand of cash after that. And they'll sell one of the regional Queensland, so another 200,000 after that. So they'll have about 750 of cash after selling those 2 properties. And now the question is, what do they do to kind of achieve their goals and hit their serviceability amounts? Now, Pat, I'm going to answer this question purely from a financial perspective. Of course, you've got to overlay the lifestyle considerations. I can't do that. You can put that in context. I can't do that. So, it's not for me to say where you to live and what you do with your kids and all those sorts of things, but I just will speak from a pure financial perspective. So, you're going to spend what was it? 2.7? Yeah, 2.7 on a home. I was going to say in the middle of nowhere. It's not in the middle of nowhere, but on the outskirts of Brisbane where, land supply is abundant. And Brisbane's a little bit like Melbourne in that it can keep sprawling out. Now, I know that there's a few national parks there and so forth that surround Brisbane, but it can really keep going on and on and on. And, that supply will hamper future capital growth. So I guess the way I'm framing this decision is that we want to go and spend $2.7 million on something that's not going to be a good investment. I just wonder if you could take a different approach. I acknowledge and I hear that you want, you need, a certain number of bedrooms in your property. But what I think I would do, that saying that if you find yourself digging a hole, stop digging. The thing is, when we make financial decisions, when we come to working out or if we get new information, we shouldn't let the past financial decision hamper our next one. And it's easier said than done, 100% easier said than done, but we've got to try and avoid doing that. I don't, you don't want to throw the baby out with the bathwater, but what I'm saying here is that, look, if we knew this is your goal, like if we could wind back time and we knew this is the goal, would have you bought those properties? Would you bought a property in Brisbane and regional Queensland and all that sort of stuff? Like, or would you have taken a different approach? If the answer, I would have taken a different approach, then why should we let those decisions maybe exacerbate another poor decision or follow it with another poor decision? So I don't want to go and say sell all your properties and put it all into one fantastic property in Brisbane, something that's in a more established suburb, something that's going to, give you a lot of capital growth. But that's actually what I really want to say. No, do you have to sell all your properties? Well, look, maybe not. Maybe you sell, I'd keep the Perth one probably. You're selling your Perth home. You said you got another one in Perth. Let's assume that that's going to enjoy the growth phase. I'd sell the 2 regional Queensland one. You're going to sell one anyway, sell the other. And then you're left with 2 in Brisbane. I don't know about the locality and the value of those, but again, you might sell one. So you might go down to sort of one property in Perth or one property in Brisbane. And hopefully that's enough to get you to the point where hopefully you can buy a really great asset in Brisbane. And you could probably do that now and use it as an investment property. So benefit from the negative gearing, particularly firstly to help in terms of affordability and borrowing capacity, but also to get into that market. And then you buy something that has good bones, something that is structurally really good floor plan, logical, the position on the block is good, the street is good, the suburban location is good. And then if you then down the track have to make some modifications, add a bedroom, for instance, you can always do that down the track. But the benefit is that if nothing works out over the next 20 years, at least you're sitting on a very valuable property with a lot of equity in it, and you can make a huge after-tax capital gain. So it's a great sort of fallback position. And, I think if your family income is going to be sort of close to $500,000, repaying the loan and being able to also invest in other assets, I think is probably still within your ambit or ability to do that. So that's what I would aim for. I think I would go and buy, in a really great quality area. Now, what's the flip side? The flip side is if you wanted to stay in Brookwater, is that the right? Yeah, Brookwater. What would you do? Could you go and, the shame would be to go and sell all these investment assets or most, and then go and put that equity into an asset, as I said, that I don't think, or I'm not optimistic about the future growth. It would be a real shame to do that, particularly since you're spending a lot of money in an area that's where the median price is going to be multiples less than that. So you're building a very unique asset. It's not in keeping with, what people want to buy in that area. And that's where you're just not going to, you're not going to get the growth or the return on that. I'd be really reluctant to actually see you sell investments to do that on a longer term basis. I think it's going to be a real weight on your financial position. So I've spoken in the podcast a lot about trying to use an investment lens associated with these sorts of decisions. The thing is, what we don't know is, you could wake up in 8 years' time and decide, hey, we're going to go back to Perth, or my job's taking me to Melbourne. That you'd be lucky if that was the case. And then if you've made a really great quality decision, you've enjoyed a lot of tax-free capital growth, you can sell that asset. You're not going to pay too much in terms of transactional costs, and you can walk away and you're still in a really good position. So that's why I really like making really great decisions with all assets we buy, whether they're own occupy or whether they're pure investment. I hope that helps, Pat. I probably haven't helped you much, although, because I've sort of just changed the strategy. But anyway. Okay, next question is from Louise. Louise asks, are there any recommendations on resources or courses for a beginner to learn financial modelling or improve their financial math skills? Look, you're asking the wrong person, Louise, because I've had those skills for many years, so I've never had to, find the resources to do that. And similarly for sort of people in my business, the same sort of thing in terms of the staff. But I would imagine there is a wealth of information on YouTube, and that's probably where I would start. Just want to be, basic financial modeling that, most people should be able to sort of get their head around doing that after watching a few YouTube videos and learning Excel and those sorts of things. But complex financial modeling, so that is you can model a property, but how do you model a full household portfolio, super, family trust, corporate beneficiary, personal names, all these sorts of things? Leave that, I would say just leave that to the experts, because if I think about the financial model we've been building over the last 10 or 15 years, it's huge and it has a lot going on. And even to build that again right from day dot, right from the start, is going to be a challenge. And I think beyond most people, but basic modeling, should be able to find that on YouTube. Okay, next question. Really interesting one from John. John writes, your podcast and book, Investopoly, have completely changed my relationship with money. I was so impressed I bought it for my brother too. Financial planning used to stress me out, but now I'm enthusiastic about our future, which brings me to our retirement plan. We would appreciate any general insights you have. Thanks so much, John. I'm really so pleased to receive such amazing feedback. I'm really lost for words, to be honest. I'm not just saying that. We all hope we go to work and do some meaningful work, but that's really fantastic. So Okay, so my partner and I plan to sell our New South Wales South Coast house and move to the Sunshine Coast. It'll allow them to crystallise about $800,000 of equity and they'll put that into super. John's partner is 8 years younger, so we'll be working for a little bit longer and they will be able to sort of exit stressful sort of corporate jobs and be able to do some part-time work. So very much for sort of lifestyle, downsize, put money into super for lifestyle. They estimate, so John's super's 300,000 at the moment, put 800 grand in there, takes it to 1.1, and over the next 8 years, John's 52, by the time he gets to 60, so 8 years time, he's worked out at a conservative 6% return, it'll be worth $1.8 million. And that $1.8 million balance will give them, between $110,000 to $125,000 a year perpetually. So like a bit of a perpetual portfolio. So far, so good. I think I'm happy with all the maths. Just broadly, I haven't reproduced the figures. John's partner has 200,000 of super and is 8 years younger. So, a little bit more working life left. And John's got a couple of questions here. Is it risky having all our money in super, just Vanguard Life Cycle super? Should we consider purchasing an investment property inside super to diversify? Should we maintain additional savings for times of higher market volatility? And is it worth consulting a financial advisor? All really great questions, John. Let me deal with them in order then. So Vanguard Super has a life cycle investment option, which means that if you're born in 1970, bang, here's what your asset allocation is. And it's kind of obviously based on, your time horizon until retirement. So if you said you're born in 2000s, you're probably going to be probably 100% growth. If you're born in 1950s, you're going to have a more conservative asset allocation. I like the lifestyle option because obviously it's set and forget. That the asset allocation will change over time and you don't need to really worry about it. And I think it's relatively appropriate as well. Now, the only thing though is, I just put it into Vanguard's website. At 52, your allocation is going to be 78 to growth assets, 22 to defensive assets. I can live with that. But the other thing too is you just really want to be, if what you're doing is saying, well, I want to make the most of my money, which is, you've written that, and the most of your opportunity, given that you're making you're sort of downsizing, moving location, better standard of life, better sort of work-life balance, all those sorts of things. But now I've got this pool of assets and I really want to make it work hard for me. What I've spoken about in the podcast before is, well, why wouldn't you be all growth? If you can just ignore volatility. So and if volatility worries you, stop looking at your account, right? So let's just say so take the human behavior out of it and just look at the maths, pure maths. Over the next 8 years, your highest return is going to be all growth. Now, if you have 80-20 allocation, it's not going to change the returns that much. I can live with that. But as I change the lifestyle option, life cycle option, I should say, when you get to 60, you're going to be 60% growth and 40% defensive. The problem with that is you're not going to get enough returns off the balance, and it might not end up being a perpetual portfolio. And so this is where I think actually it's a little wrong, these lifestyle thing. I like it as, you go through your working life, but lifestyle may not be appropriate as you get into or closer to retirement. Whereas you want to make the most of your money, well, why don't you just stay fully invested in the market as much as you possibly can? An 80-20, take that through the rest of your life, for instance. I don't think there's anything wrong with that. Now, there's going to be years where you're drawing a pension and after the market has crashed by 30 or 40%. And so you're going to be taking money out of that account at times when, arguably investments are undervalued. But equally, there's going to be times where it's fairly valued and there's going to be times where it's overvalued. I think it all just levels out. And the whole idea around asset allocation is really just about smoothing returns and then making people feel comfortable, making sure that the portfolio lines up with the person's risk profile. But as I've spoken many times, I think risk profile is really just an education piece. Because if I'm talking to John and saying, okay, you've got this asset, you can grow it to 1.8, now let's try and make that money last as long as possible. Well, you've got to make friends with remaining fully invested. So Vanguard, I'm going to produce a podcast. I'm planning to. I haven't written it yet, but I'm going to plan to produce an episode leading into my end of year analysis of and comparison of super funds. I want to do a deep dive on Vanguard Super. That's the plan at the moment, no promises. So at this stage, I don't have any concerns with being all in Vanguard. It's really just the asset allocation. I don't have any problems with the lifestyle asset allocation at 52. But as it gets more conservative, you just might want to think about whether that's going to be appropriate for your circumstances. Should you consider purchasing an investment property inside super? Well, you'll have 1.1 mil of super. If you do a property, the problem is that you may as well do it well. There's no point buying a substandard asset, which means that and you probably want some conservative gearing given you're going to be working part-time, your super contributions aren't going to be really massive over the next period of time. Although you did say about $25,000 a year for the next 5 years. My point is that you'd be almost all in with property in terms of making sure you've got a conservative gearing level means you've got to put a lot of cash in there and you'll then be topsy-turvy. So instead of doing it for diversification, you're actually going the other way because you've got concentration in property. And I just don't think your time horizon's long enough. If you want to start drawing a pension in 8 years' time, you need to sell the property in that time so that you've got the liquidity to draw a pension. And, that just doesn't suit you. As I said in my previous answer, property's a 10 plus year proposition. Should we maintain additional savings for times of market volatility? Look, you could have to make yourself feel more comfortable by the time you get. So, no is the answer for today, like for the next 8 years. But when you get to age 60, one of the ways that you could kind of accommodate maintaining a more aggressive asset allocation, but still making yourself really comfortable is that, and I'll just use your figures, your projections. You project you'll have 1.8 of super by the time you get to 60. What you might do is say, okay, I'm going to invest 1.5 million of that in an account that's going to be relatively high growth or maybe even all growth, for instance. So whether it's 80-20 or 100% growth, whatever. And then you might say, I'll take these 300,000 and I'm going to invest that really defensively. And 300,000 because it's broadly kind of 3 years worth of living expenses, 3 years worth of pension payments, if you like. And whether it's 3 or 2, I don't know, I'm just using it as an example. And defensive, it would be like mostly fixed interest, fixed income. So it's going to be, really capital stable. And that approach might give you a lot of comfort to know, hey, I'm willing to take a lot more risk on the 1.5 on the basis that if I want to, I'll just start drawing a pension from the 300,000. And you might leave the 300,000 in accumulation so you don't have to draw a pension. It's just there as a bit of a safety net. Let's call it 200 just to be a little bit more conservative. And the 1.6, it might be the one that's kind of in pension phase. And then the whole idea would be, at least then you can draw from the other account. Now, actually, just thinking about that as I'm talking, you might not be able to do that in the life cycle option, but you could certainly do that in terms of, I'm pretty sure the flexibility of Vanguard would allow you to, it sort of acts like a wrap platform where you could have a bunch of investments. So you could invest in Vanguard Growth and then Vanguard very defensive. So premix your own option. I'll look into that when I do the episode on Vanguard in terms of what are the options there. But that's the way I would structure it. So you're still exposing the portfolio to the maximum growth, but then you've got the safety net of not needing to sell if the market drops 40%. Is it worth consulting a financial advisor? I like your plan to date. As I said, life cycle works in terms of asset allocation today, maybe not at 60, but certainly today. And, subject to my episode on Vanguard, and, I haven't done the research yet. I've got the research. We pay for independent research. I haven't read through it yet, but I'll get to that. So subject to me not coming up with anything there, I don't think you need any advice. Will you need advice at age 60? Maybe. I mean, it just depends on your circumstance. It could be worth paying for sort of one-off advice at that particular time. But I like your idea of keep it simple, keep it low cost, downsize, better sort of a balance of work and life over the next 8 years. I think it really works. There's nothing here that suggests that, there's any big gaping holes that you need to get advice on. So Thanks very much for that question, John, and hopefully helps you and everyone else like you that thinks about, how will I build a nest egg, and then how will that nest egg work really hard for me in retirement so that I'm capturing all the returns that I can while still making me feel pretty comfortable. Okay, I might leave it there for today. Tomorrow, Campbell joins you. Really good episode. How to set a property budget. How do you set a budget in terms of whether you're buying a home or investment property? What are the considerations? Really, really important decision getting that budget right. So he'll join you tomorrow, and that's it for me for today. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.